Most people look at a balance sheet and feel completely lost. Numbers everywhere. Terms they have never heard before. And no idea what any of it actually means. But here is the truth. A balance sheet is not complicated. Once someone explains it simply, it makes perfect sense. In this video, I am going to walk you through a real balance sheet. Line by line. In plain English. No accounting degree required. By the end, you will know exactly what a balance sheet shows, what each section means, and how to use it to understand the financial health of any business. Let's get into it. What is a balance sheet? So what exactly is a balance sheet? A balance sheet is a financial statement. It shows you what a business owns, what it owes, and what is left over for the owner. All at one specific point in time. Think of it like a photograph. Not a video. A photograph. It captures the financial position of the business on one specific date. For example, December 31st. Or the last day of the quarter. The balance sheet is built on one simple equation. And this equation is the foundation of all accounting. Assets equal liabilities plus equity. Assets. Liabilities. Equity. These are the three parts of every balance sheet. And we are going to break down each one right now. Assets, what the business owns. Let's start with assets. Assets are everything the business owns. Everything that has value and belongs to the company. Assets are split into two groups. Current assets and non-current assets. Current assets are things the business expects to use or convert to cash within 1 year. The most common current assets are cash. The money sitting in the bank right now. Accounts receivable. Money owed to the business by customers who have not paid yet. Inventory. Products the business has in stock ready to sell. Prepaid expenses. Things already paid for in advance, like insurance or rent. Non-current assets are long-term assets. Things the business will use for more than 1 year. Common non-current assets include property and buildings, machinery and equipment, vehicles. Intangible assets, like patents, trademarks, or brand value. All assets are listed on the left side or the top section of the balance sheet. And they are always listed in order of liquidity. That means the easiest to convert to cash comes first. So cash is always listed at the very top. Liabilities, what the business owes. Now let's look at liabilities. Liabilities are everything the business owes to others. These are debts and obligations that must be paid. Just like assets, liabilities are split into two groups. Current liabilities and non-current liabilities. Current liabilities are debts that must be paid within 1 year. Common current liabilities include accounts payable. Money the business owes to its suppliers. Short-term loans. Borrowings due within the next 12 months. Accrued expenses. Expenses that have been incurred but not yet paid. Like salaries or utility bills. Tax payable. Taxes owed to the government. Non-current liabilities are long-term debts. Due in more than 1 year. Common non-current liabilities include bank loans. Long-term borrowings from a bank. Mortgage. A loan secured against property. Bonds payable. Money borrowed by issuing bonds to investors. Liabilities appear on the right side or the middle section of the balance sheet. They are also ordered by urgency. The ones due soonest come first. Equity, what belongs to the owner. The third section is equity. Equity is what is left over for the owner after all debts are paid. Here is a simple way to think about it. Imagine the business sold everything it owns today. Then paid off every single debt. Whatever is left, that is the equity. That belongs to the business owner. Equity is also called net worth or shareholders' equity. The main components of equity are share capital, money originally invested into the business by the owners, retained earnings, profits that have been kept in the business and not paid out as dividends, drawings or dividends, money taken out of the business by the owner. If the equity number is positive and growing, that is a good sign. The business is building wealth over time. If equity is negative, the business owes more than it owns. That is a serious warning sign. Why it always balances. Now here is the part that confuses most people. Why is it called a balance sheet? Because both sides must always be equal. Assets must always equal liabilities plus equity. Always. No exceptions. Here is why. Every asset in the business was funded by someone. Either by borrowing money, which creates a liability, or by the owner putting money in or the business earning profit, which creates equity. So every dollar of assets on the left side is matched by a dollar of liabilities or equity on the right side. The two sides always balance. If your balance sheet does not balance, something has been recorded incorrectly. A real example. Let me walk you through a simple real-world example. Imagine a small bakery business called Sarah's Cakes. Here is what her balance sheet shows on December 31st. Assets. Cash in bank, $8,000. Accounts receivable, $3,000. Inventory, $2,000. Baking equipment, $12,000. Total assets, $25,000. Liabilities. Accounts payable, $4,000. Bank loan, $8,000. Total liabilities, $12,000. Equity. Owner's capital, $10,000. Retained earnings, $3,000. Total equity, $13,000. Now let's check. Total liabilities plus equity, $12,000 plus $13,000, equals $25,000. And total assets are also $25,000. It balances perfectly. What does this tell us about Sarah's business? She has $25,000 in assets. She owes $12,000 in debts. And the owner's stake in the business is $13,000. That is a healthy-looking balance sheet. Things to look for when reading any balance sheet. Now that you understand what a balance sheet is, let me give you 3 things to look for every time you read one. Number 1. Is the equity positive and growing? Positive and growing equity means the business is building value over time. Negative equity is a red flag. Number 2. Can the business pay its short-term debts? Look at current assets and compare them to current liabilities. If current assets are higher, the business can cover its short-term bills. This is called liquidity. And it matters a lot. Number 3. How much debt is the business carrying? Compare total liabilities to total equity. If the business owes far more than it owns, that is a sign of high financial risk. A balanced mix of debt and equity is healthier. These 3 checks will give you a quick picture of any business's financial health in under 5 minutes. And that is how you read a balance sheet. Let's do a quick recap. A balance sheet has 3 sections. Assets, what the business owns. Liabilities, what the business owes. Equity, what belongs to the owner. And the golden rule, assets always equal liabilities plus equity. Every single time. If this video made the balance sheet click for you, please hit the like button right now. It genuinely helps this channel reach more people who need this content. Subscribe to Debit Decoded for more plain English finance and accounting videos every week. And drop a comment below, tell me one thing you learned today. I read every single comment and I reply. The next video covers the income statement, the balance sheet's best friend. Click the card on screen to watch it now. See you there.